Welcome to the ninth CoopCongo dialogue. Today it is Divine Mouland to lead us. Thank you again for making the time. Merci pour le temps d'être, pour votre temps d'être parmi nous. Et nous serons conduits par Divine Mouland ce soir. Merci. Divine.
Good evening, everyone. First and foremost, thank you for making the time to come out on this Thursday evening, as most of you always do. As much as, it's needed for us to come out here, but it's still you taking your time to just learn and to educate yourself on everything that we're trying to do and where we're trying to take this community. So it's really glad to see the same familiar faces all the time. And hopefully, as time goes by, we can see different faces and get a different feel from everything. Tonight was really just us as the Saving and Investments Committee coming together to educate you. I think a lot of the times we assume that people know what is happening. We assume that people understand certain terminology. And as we saw from the survey that we did, a lot of the assumptions that we make are actually not true. So we wanted to take time today and educate people, firstly about investments. What is investments? What type of investments are they? I want to make note that the investments that we're presenting today is not necessarily the type of investments that we're going to offer as a savings and investment committee, but rather just to educate people and to make people aware of what is out there. Secondly, we'll be looking at savings and just to understand what type of a savings culture is needed in our community to get this organization going. A lot of time and effort has been taken into presenting something that everyone can understand, everyone can almost take in. So we hope that the great work that Eric has for us tonight is really going to see us through. So yeah, Eric, on to you.
Merci, Divine. Sure, no pressure.
None at all. None at all.
Thank you for that. I think you can see my presentation, right? My screen. You can see it
yes,
fine.
You can.
Okay. Yes. Thank you for the opportunity. Thank you to the chair. Thank you for this opportunity to be able to speak to everyone this evening. Those of you that were in our session last week when we were going through the survey, one of the key takeouts from that survey was around education. I think as someone in the financial industry, it's very important that we keep educating ourselves. We are starting a community bank, and those two words are important. Bank obviously is financial. Community means it's all of us. We are all in the process of building this bank together. So as we do that, we need to pull each other, and we need to educate ourselves, empower ourselves, so that we don't repeat the mistakes that other organizations have made in the past. So these sessions are very important, and I hope that tonight I will add some value in our community and in our lives. So as Divine mentioned, I'm part of the loan savings and investment committee, and basically our job is to try and number one, create policies, create procedures, and eventually propose products that are tailored to the needs of our community. And there's different ways we are doing that: surveys, gathering data, information. We use our experiences in the financial industry, etc. And we use that really to come up with proposals for the board to approve. Tonight, what I wanted to do was to really speak about investments and savings from the perspective of an investor. An investor is everyone on this call. If you are a member of CoopCongo or if you've bought some kind of product somewhere, you've taken part in investment one way or another. And in my experiences in the financial industry, what I find is that there's a disservice that financial professionals give to the average person, and that disservice is basically a what I'll call a asymmetry of information or a information failure. What I mean by that is typically when someone from an average person goes to a financial institution, they are well aware that they don't know much about finance, and the person that they interface with knows way more material and knowledgeable information about whatever they're selling to them than they would know. So that's normal. Obviously, if I go to a doctor knows more about medicine than me. Or if you go to a dentist, it's normal also in the financial industry. I think what makes the financial industry different is that the incentives are different. Typically, if you go to a financial institution, say for example, I go to Ellen Gray, it's very, very unlikely that an investment professional at Ellen Gray will look at my needs and say, actually, for you right now, you should get this product from Old Mutual. They will, whatever need you have will result in you getting something from Ellen Gray. And that's across the board. So the incentives in that field are a little bit different and do not always align to the investor. So obviously, it's not because they're bad people or anything like that. It's just that the industry works a bit different. So that information gap, or the asymmetry of information between the investor and an investment professional or financial professional, to be more broad, the gap between those two is usually in the jargon that people use. So jargon, everybody is aware of jargon. Like the language that they use can sometimes be confusing for someone that's not accustomed to being in that field. Most people will understand basic concepts. Things like inflation. We have some idea of what inflation is. We'll have a good idea of what things like interest rates are, or maybe unemployment rate, etc. We have a good understanding of that, but when you go to an investment house and they start talking to you about rates of return, diversification, maybe even PE ratios or dividend yield, etc., those can become very confusing. And sometimes even they want it to be confusing because then it's a sense of, well, you don't really need to know this. You pay me to know this, so you can like just worry about getting your money. So that's typically how that field tends to work. So, in the interest of educating our community, also in the backdrop of us building a bank, I think it's important for us to understand a lot of these concepts because when you simplify these concepts, they're actually very basic. There's not a lot of complicated stuff. I mean, there are some, but most of it is very simple. But what I wanted to do today is try to simplify it, but to use the same jargon. So when someone mentions something like asset allocation, you have an understanding of what it means at a conceptual level, because that's really where it's important. The jargon can be used interchangeably, but you need to make sense of exactly what they are saying. So the idea today is, number one, to simplify some of these concepts at a very high level. So it's not going to be a deep dive into investments or savings or anything like that, but it's just to understand some of the basic concepts and also some of the language. I think as a bank, we need to start speaking with that language as well, because number one, those are the products that we're going to sell need to speak to those needs. needs to speak to our community, but also we interact in a world where these jargons are used. We need to understand what it means. It's just going to benefit us as a bank. So I think without further ado, I'll go into the presentation today. Cool. So I think at a high level, what I want to do is to start with at a very basic level. We're talking about investments today. So what is an investment? What does the term investment actually mean? And what I wanted to do was to try to use textbook language. I didn't really do that well, but essentially, an investment is an asset that is acquired for the purpose of generating wealth. Okay. And this asset can generate wealth in one of two ways. It can generate wealth either through income or cash flow, which can be a regular cash flow. I'll explain that in more detail. Or it can generate wealth through capital appreciation or capital gain. So a gain in value. And what I did on the slide that you're looking at is you'll see that I have a tree and a tree that has fruits. So the tree itself would be the asset, and the fruits would be the income. So as an asset, I can make money by selling the tree with its fruits, or I can sell the fruits, which will give me cash flow. So you can imagine if I start a farming business and I don't necessarily want to sell the land that my tree sits on, I can just sell the fruits of that tree. That will be cash flow that I'm generating from an asset. Or I can just sell the tree itself, which will be capital growth from when I planted the tree to where it's at now. So it's all about generating wealth over a period of time. And then I went a level lower. What is an asset? I think we generally have an idea of what an asset is, a conceptual idea, but for any accountants on the call, it's really, maybe will be able to correct me here, but it's a resource controlled by an entity or an individual from which future economic benefits are expected. So again, if you look at a tree as an example, you plant a tree today because you're expecting it to grow over time. As it grows over time, you can make money from it by either selling the fruits that that tree produces, which would be the income part, or you can sell the tree itself with its assets, which would be the capital growth. So that is essentially an investment. Okay, so if we go into the next level, in the investment world has a lot. You can invest in anything really, because if you think about, just see there's a message there for me. Oh, okay. I thought you could see my slides. Sorry.
We can see your slides. Maybe they just need to slide to the left.
Oh, okay.
If they can try slide to the left, because your slides are showing, I can perfectly see it.
Ah, okay. No problem. Okay. So what I was gonna say is that there's a lot of different types of assets that you can invest in. As we looked at, the definition is anything that you expect or you buy to generate wealth in the long term. So what investment firms have done is they now look at the different assets that exist in the market that can provide some kind of return, and they will group those assets based on certain characteristics or profiles of those assets. Okay, so what I mean by that is certain assets perform very well when market conditions are moving a certain way. Certain assets perform very well when there's less volatility. Certain assets perform very well when the interest rates are high or low, etc. So a good way to understand that for the market, for the investment world, is to classify these assets. And the term they use there is called asset classes. Okay, so that's the word that I have there in red, asset classes. And all asset class is classification of assets based on the characteristics of those assets. Okay, broadly speaking, and companies use these differently. Some of them will classify them a bit differently, but essentially you'll have the equity asset class, and the equity asset class will usually be about shares, which you see on TV all the time. So the stock markets. Equity could also be buying a business, so buying ownership in a business or private equity. You would have heard about things like unit trusts, ETFs, ETNs. All those fall in the equity asset class. Uh, there are other characteristics that make them fall in that same asset class, which I'll explain in a bit more in the next slide. But essentially, it also deals with the type of risk profile equity assets have compared to relative to other assets. The next other popular asset class is property. Um, Actually, I was on a call earlier today, and I was talking to a colleague of mine who manages a portfolio at one of the banks, and was talking about how bad the bank is performing because so many of their assets are invested in property, in actual property buildings, and those are not doing well right now. So property is obviously residential property or commercial property. Property can also be property managed funds. And what I mean by that, you've got some unit trusts, and I'm assuming people know what a unit trust is because that on its own can be a topic for another day. But you've got some unit trusts or some funds that invest in property. So you might think you want to buy a property to invest, but you might also rather take away the risk for yourself and pay a company that buys properties as an investment, and you get the benefits from that. So there's lots of different ways to invest in property, but that is a separate asset class. Um, you then have fixed interest as an asset class. Fixed interest will typically be things like bonds, corporate and government bonds. So bonds are usually debt instruments that some large companies, think of companies like ESCOM, or the government, for example. They're not necessarily just going to rely on the market, especially the government's not a listed entity, so they're not going to go into the market and offer shares. When they want to raise large sums of money, they issue bonds. And I think a relevant one in your lives might be something like a mortgage bond. So it's a debt instrument. And basically it says the government says loan us R1 million, or usually way more than that, and we will pay you back what's called a coupon rate on a regular basis. So maybe we'll pay you back a rate of interest at 2% of the value of that bond over a period of time, which is called a maturity date. But essentially, fixed interest would be things like corporate bonds, treasury bills, etc. And again, they have a certain characteristics, and I'll show you in the next slide what I mean by that. The next one, which everybody is well aware of, is cash. Cash is your fixed deposit accounts, your savings accounts. In the survey, we saw a lot of people say they keep their money in their savings account or at home. I think at home is not really an asset class, but your savings account is cash. That's basically the asset class that would be classified for that. You then have alternatives. Alternatives are basically types of assets that do not easily fit into those other official asset classes. So things like commodities. Commodities are people that trade in oil, maybe wheat, rice, gold, silver, palladium, etc. They don't automatically fall into equity or property or whatever. They're classified as alternatives. And then there's other more complex products like derivatives, hedge funds, etc. And then you've got other. So if those other five, if your asset doesn't fit in those other five, it will fit in other. And other is things like an expensive painting. Some people collect watches that they maybe sell over time. I know, for example, if you follow sports, I know in America, for example, baseball cards are very popular. You know, you could have a baseball card that was from 50, 100 years ago. You could sell it for millions of dollars online or whatever. Those would all fall under the other assets. And other is obviously less liquid because there's no open market for it. So you may struggle to find a buyer, or you have to source your buyers yourselves. And it's also hard to quantify the price of these things just because of the characteristic of those assets. But I think without going into too much detail, the point of this slide is that you know what an investment is. Is that it's an asset that you buy to generate wealth over time, and there are different types of assets. Those assets are then classified in what's called an asset class. Okay, and that asset class is based on the characteristics of that asset. Those characteristics can be relating to risk, can be related to liquidity, can be related to maybe regional trading, where it's mostly traded, etc. It will then get classified, and it's just an easier way for investment for the investment world to know what you're dealing with when you're talking about investments. Okay, so the next slide just goes one level lower with the asset class. So when you're going to invest money, you want to understand which asset you are going to invest in and what are the payoffs for that. So remember, I spoke about different assets have different characteristics. One of the biggest characteristics in the investment world is risk. So some assets are more riskier than other assets. In the investment world, we always say that an investor is risk averse, which means that you want the highest possible return for the lowest possible amount of risk. It's logical. You know, no one wants to just take on risks. You must take on risk within your limits, and you need to understand how much risk and what you get out of taking that risk. So the reason we classify assets is also to understand the amount of risk that asset has, and also what benefit you get from it. So if you look at the equity asset class, for example, like shares, they can be very volatile. You know, because it depends on a company, how the company performs, etc. So the risk is generally higher, but it gives money. Its biggest return is the capital growth. So obviously, if you buy a share for 5 rand today, or like you buy a CoopCongo share for 10 rand, in 20 years' time, it's worth 20 rand. You've made a pretty good gain over that time. Okay, and that's generally why people buy shares, because of the capital gain that they can make. Shares can also give you good dividends, which is an income part of that equation. So if a company does really well, it could also issue a dividend, which is a good income to get from owning a share. Fixed interest, that's where I was talking about bonds. They are typically low risk, because if you're borrowing money to the government, for example, it's unlikely that the government will go broke. Well, I mean, it's possible, but relative to an equity stock, it's less likely that a government will go broke. So it's classified as lower risk, and that also means that the returns of that asset is not as high as shares. Okay, and that also means that you get a cash flow. Like I was talking about bonds, they offer coupon rates, so they'll offer regular cash flow. So the return for fixed interest is generally income, not capital growth. You don't invest in a fixed interest instrument to get capital growth. So cash, very similar to fixed interest. Cash, like your savings account, anyone that has a savings account will know that you do not get amazing returns there. It's just a very small change in your interest, and I mean, it's an income or cash flow instrument. I mean, doesn't really give that much, but that's the purpose cash has. It's more a safety thing. It's a very low risk. Your money is safe in the bank, you know, and maybe you planning for something in the short term, and that's why you keep your money there. I think things like money markets, fixed deposits, etc. That kind of idea. Property, again, as we discussed, property is medium risk because it depends on the type of property investment you're making. And as you know, property can either increase in capital growth, or it can also provide you an income, especially if it's rental property, you can get regular rental income. So that varies. And alternatives and other, because of how they are, how they work, there are different types of alternatives. So for example, you cannot say gold moves exactly the same way as oil does. There's very different factors that move those things, so they don't always correlate. So it really depends on what asset you go into when it comes to alternatives and other. But they're generally good for capital growth. Some of them will give you regular income, especially if you look at something like a hedge fund. Depending on how it's structured, you could get regular income. But the point of this slide is really to talk about that little pie graph on the right. So when you go to invest your money, what they'll typically say is you've got R1 million and you want to grow your wealth over time. Instead of putting all your R1 million in equity, for example, they'll use a term called asset allocation. And what asset allocation is how do you split your assets in such a way to maximize your returns? So, and the next slide will maybe touch on it a little bit more. So asset allocation is just saying, instead of putting my R1 million into equity, why don't I put 700 in equity and I put 200 in fixed interest and I put 100,000 in cash? In that way, if the volatility in equity affects me negatively, I don't lose all my money because I've got some of it in cash, etc. So the thinking behind that is called asset allocation. And it's a very, very important concept in the investment field because, like I said, most people are risk averse. So they'll always look at ways they want to know how much they'll get and how little risk they want to take or have to take to get that money. So asset allocation becomes very important in that space. Cool. So we understand what asset allocation is. What 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 next? So what happens next when you're about to make an investment? So different assets have different characteristics, and based on the characteristic, it's grouped into an asset class. And based on your predispositions, your experience, your appetite of risk, you will then be assigned a certain asset allocation. Okay. As I said, the asset allocation helps to identify the desired mix of assets to maximize your returns. So there are other factors that go into investing that you need to take into account. Even as a member of CoopCongo, as someone that just wants to invest for retirement or for the next 10, 15 years, these things are always important. So before you go into an investment house, you need to be able to answer the questions for yourself because, like I was saying, that there's a lot of jargon the minute you walk into Old Mutual's office. But there's a lot of things you can be able to answer for yourself to make sure that by the time you get there, you have filtered out a lot of the noise. Because if you just look at fund sheets, you look at the news, there's a lot of noise. How do you limit the amount of noise in your decision making? So what you'll typically need to understand is your investment mandate. The investment mandate, in pure investment terms, talks about things like your risk profile. And a risk profile in the investment world is generally they'll give you a set of questions that asks you about yourself, asks you about your tolerance for risk, and they'll say this investor is moderate, this investor is aggressive, this investor is balanced, or whatever. They'll classify you based on how you answer those questions. Okay, that investment mandate then informs what products they can offer you. Okay, so it's a way for them to filter out what you should be buying, or what you should be buying from that company. So what I wanted to do is to go through some of the important questions to consider for yourselves, and these are not purely investment questions, but they lead you to getting the right sort of making the right decision. Number one is your investor time horizon. What does that mean? What is the time frame you are looking to invest for? Is it a short-term investment? Is it an investment of between 3 to 5 years? Is it an investment for retirement? Is it an investment for 5 to 10 years, etc.? That question is important because that then helps you understand whether you can take on more risk. So if it's something that's going to be for 20 years, means that in the short term, I can handle a bit more risk because over time, I'm expecting my capital to grow. But if I'm saving money for a car, for example, and I use the word saving carefully, but if I'm saving money for a car, it doesn't make sense for me to take on a very high risk investment where I could lose my money in the next 3 months. Like, it would be very risky to buy Bitcoin and hope that I'm going to use that Bitcoin money in 2 months' time to buy my car, because that could go very, very well, or it could end very, very badly because it's very volatile. Okay. The next thing is the risk profile. So the risk profile, as I said, is your tolerance and perspective of risk. Of risk. Usually, most people say, yes, I'm okay taking on more risk. I'm fine as long as I'll get a return. But always remember that past performance doesn't guarantee what's going to happen in the future. I think everyone knows that, especially with COVID. No one, all the performance of funds that you saw last year, they would not have predicted what happened this year. If you invested in property last year, you could not have foreseen what happened this year. So you need to understand how comfortable you are with risk. Are you comfortable with losing 60% of your money, 100% of your money? Some people that invest in things like derivatives, you could go into negative 100% of your money, where you actually way, way, way worse off than where you started off. So you need to properly understand the implications there. The next thing is liquidity and accessibility. How easy is it for you to access your money? How liquid is your money? Okay. Um, Things like shares, unit trusts, etc. They are traded in the market. They'll be traded on the JSE or whatever. Those are very liquid. I can easily get my money out of there 3 to 5 days. The money is there. A fixed deposit is 30 days, but most cash instruments, it's easy to get your money out. Now, compare that to you investing in a house, in property, and you want to get your money. It's not going to be 3 to 5 days. So again, because of the type of asset it is, it will have different constraints when it comes to liquidity and accessibility. And that's something you need to understand. The next one is tax considerations. So tax is very, very important, and I'm also aware that every one of these things in the investment world, in the financial world, every one of these things can even be a discipline on its own. There's things like behavioral finance. There's tax specialists that will only specialize on certain types of taxes. So it can be pretty involved, and this is very high level. But there are the different assets will have tax implications. For example, if you are getting capital growth, if you have a capital growth asset like shares, shares when you sell a share, there's a concept of realized and unrealized gain. Basically, your gain is your unrealized gain is if the share is now at 10 rand. Well, if I bought my share at 10 rand and it's now worth 15 rand, my unrealized gain is 5 rand, right? I only realize that gain when I sell the share. That's only when I make the profit. When I make that profit of 5 rand, there's a tax implication called capital gains tax, or CGT. Okay, and the capital gains tax just means that based on the gain that you've made on this capital asset, we will tax you. And there's different rules around what can be taxed, how much it gets taxed. There's a inclusion, exclusion rules, etc. But at the end of the day, sometimes even with your second or third property, if you sell it, you will be liable to that capital gains tax. So when you're going into equity, just know that there's that capital gains tax when you realize your gains. The other income that you make from assets like equity is dividends, of course. So dividends are good to have because the company generally pays that dividends tax. So when you receive the money from your dividends, you're not taxed on it. It's taxed, but you're not the one paying the tax. That tax has been, they call it a withheld or withholding tax. So that tax is withheld by the company and paid over to SARS. So your money that you receive is tax free to an extent. So and you'll see a lot of articles about very wealthy people pay very little tax, but that's because these wealthy people have assets and they get capital gains tax, which is much lower than your normal tax that you pay, your marginal tax, as we call it. So they've structured their assets in a way that they are getting either dividends or capital gains. They're not getting normal salaries or things like that, which get heavily taxed. Cool. When you look at other assets like property or cash, or even things like retirement annuities, those things are taxed in your on your marginal rate. So they taxed as if you're receiving an income, and that tax is much higher than what you'd normally pay for the capital gain. So again, you need to understand that if I invest in this kind of asset, this is the kind of risk I'll be taking. This is the kind of value I can get from it, either capital growth or income, and this is the kind of tax implication that that asset will also have once I decide to sell or I start receiving regular money from it. So the whole idea of this slide is you go in here with a lot of noise. All you have to do is find any financial paper out there. You'll see that there's a lot of products. There's a lot of different types of products. There's a lot of creativity in this industry, and it's also it's very difficult to pinpoint exactly what you're looking for. But if you can sort of answer these questions for yourself, it narrows it down a little bit and it helps you filter and also helps you have a more informed conversation with whoever you're dealing with. The other thing that I didn't mention here when I talk about other considerations is some people want to invest in socially responsible investments. So maybe you're against tobacco shares, or you don't want to invest in arms companies, or you don't want to invest in alcohol. There are or one that's very popular right now in the industry is Sharia funds that invest using Sharia law or Muslim law. I don't want to I don't understand it 100%, but I know that that's a very or they call it Islamic banking. There's a very big field out there just for those kind of people. So there's a lot of creativity in the field in the industry, and that's why it's important to be able to have these informed discussions and have a basic understanding of what's going on before you even go and you buy a product. By the time you go to Alan Gray, Alan Gray is going to give you what Alan Gray sells. Cool. Okay.
Eric,
Yeah.
Eric,
Go ahead.
I want you to take a breather and just stop for 2 seconds because there's like 20 minutes left and I think the questions are going to be flooding in. So maybe my idea is let's try cut it and stick it to investments today. And then next week, try and get into savings and, put together the savings and investments. Otherwise, I think people will have a lot of heart-burning questions that we won't be able to answer in the time that we have left, if that's okay.
No, that's fine. That's fine. Yeah.
Yeah. But on that, take some time, but I wanted to add something very important that I saw in the investment industry when I was there, is that people need to be very honest to themselves when they, answering what their investment mandate is or what type of investor they are. Because if you try and, be someone else and try to be an aggressive investor when really your lifestyle allows you to be a more low risk investor, it's a detriment to you, and it's a detriment to the money that you are putting in. So I think that's a very important conversation that we need to have, that you need to be honest to yourself first before you are honest to your bank when you are stepping into the investment world.
I agree 100%. And sometimes we don't know what we don't know. Which puts you already in the back foot. When you go to these institutions, it's like a sheep entering a room full of wolves. so you need to arm yourself with some kind of knowledge and self-educate, because my view is that a lot of these things are not really complex, but people don't have the time, or even the need, don't feel the need to try and understand these things. So yeah, I agree with you 100%.
So I think we have a lot of questions, and there's one that has just come in now from Mr. Mpasa, and he says, if I have many cars, what type of investment asset is that?
If you have many cars.
Yeah. So let's say I have, 10 cars. Is that a type of investment asset?
So yeah, I think if we look back. Sorry, is there a follow-up
Continue.
question to that? Okay.
No, he's saying for class, yeah.
Okay, so that's a good question. So if you look back at what, when we talk about an investment, is an asset from which an asset which you buy, which you expect will generate some kind of wealth over time through either income or capital growth. A car doesn't offer capital growth, and unless you are selling these cars, a car depreciates from day one. So in terms of investments, you would not see a car as an an asset to invest in. It's an asset because you own it, especially when you've paid it off, you own the car. But in terms of what class it would fit in, I would say equity in a sense, because you own it, but it's not an investment at all.
I think the follow-up question to that is, when you go to the bank, they ask you if you have cars and they count it as an asset. Is that
Yeah.
correct or not?
Yeah, it is because you own it, so it's something that you own. If we go back to the definition of an asset, a resource controlled by an entity, yes. Future economic benefits, no, not really, debatable. But you own the asset, especially if you've paid it off. It's your car, so that doesn't change it. But uh, there are assets that are not necessarily going to be an investment, and I think that's the key here. It might be an asset, but it's not necessarily an investment asset. It's not going to build. It's not going to help you gain wealth. And unless you're selling cars, it's not going to do that. Cars depreciate. I think within 5 years, a car is completely depreciated in value.
Do you maybe, if you want to add to that, maybe add an interesting dimension to that question, but what about if you use your cars as Uber and you use
Yes,
it, and
yes.
can that maybe start talking about income rather than a capital gain?
100%, yes, yeah, and it goes back to the principle. If you are using it to generate an income, you're using it to generate or to gain wealth, then in that case, 100%. So I think maybe that question, if you unpack it, it could start making more sense from an investment perspective. If I buy 10 cars, or if I'm a taxi owner, for example, vehicles in my life are very different from what vehicles are for you to get to work, etc. So that context is important. Yeah.
There's another question that came up now, and it said Robert Koisaki doesn't consider property as an asset because it doesn't generate income. Can you give clarity to that? Can you give,
Sure.
what's your opinion on that?
It's scary to be the person in CoopCongo that's gonna disagree with Robert Kiyosaki. But no, look, property is well, it fits the definition of an asset. If you look at what an asset is, like textbook definition, a property is not an asset because it does not generate money. That really depends on a lot of things. As I mentioned, so for example, Liberty, the insurance company, owns Santon City, the mall. So, Liberty invests in a lot of properties, and you wouldn't necessarily know that unless you involved somehow with Liberty. But properties can make money and do make money. They're not as easy to make money depending on the market and etc. So the argument could be there are other better performing assets, maybe, or it's not as easy to make money. But to say it's not an asset is just not true. It's not factual. Yeah.
Definitely agreed. Definitely agreed. Are there any other questions? Raised hand. If someone wants to unmic themselves, maybe.
Yeah, I was wondering why it's so quiet.
I think you overflowed them with information. Maybe some.
Can I just comment? I think. Thank you, Divin. I think Robert says that a property is not an asset, in the sense that the property in which where you're staying does not generate money. So according to him, an asset has to generate money. If it doesn't generate money for you, it means you are spending money to maintain it, to keep it, which houses in which we are staying are not generating funds for us. So therefore, it is not an asset, according to him.
Yeah. Look, I can't. Thank you for that. I can't disagree with that completely. So if you look at the definition of an asset, maybe until you own the house, it's owned by the bank, can get technical and things like that. But yeah, I can understand that perspective. But just like we said, a car is an asset, but doesn't really make money for you either. Unless you have a taxi business, then it's a different conversation. So I think that falls into that category as well. If you had an accountant here, I'm not an accountant by profession. I think you'll struggle to convince an accountant that a house is not an asset. If you look at the pure definition of what an asset is.
Okay. Patrick Ngoyi has a raised hand. So if you would please unmic yourself, unmute yourself so that we can hear your question, Patrick.
Thank you, Devine. I would like to respond to Mr. Mark on his comment around what Robert Kiyosaki is saying. So he is looking at it from a perspective of income, while I think the investment, when we speak about investment, we're looking from a perspective of growth. And in a property, you also have capital gains, to what Eric spoke to. So you may be living in a house that this doesn't give you income, but essentially you actually have equity in that house, in the sense that there's some capital gains that you'll gain should you ever one day sell the house or not. So in that sense, that asset is that house is an asset because you have equity in the particular asset. So I agree with Eric that a house, irrespective of whether it's a rental property or whether it's a building you live in, it should be an asset to you because essentially you have equity in that property.
Definitely speak truth. Any questions, guys? I feel like we're a bit, I don't know, nervous today on the investment topic when it's.
Can I ask a question? Yeah?
Please, by all means.
Yeah, because that entity of asset, house being an asset, has got parameters. I don't know. I'm talking as a doctor, okay, but with a bit of knowledge in finance. Because they say a house can be an asset. Most commonly is a liability. As long as you stay there and you are still owing to the bank, okay, it's a liability. It can become your asset when you pay it out. And what you can generate by you investing in your loan is also an attribute of growth. Because compared to fixed deposit, any money that you put in your house, what they call asset bonds, it generates more interest than the fixed deposit. Mm-hmm. So Jason Lee says, lesson says that house remain a liability as long as you still have to pay for the loan to finish your own. It become an asset when you complete to pay, and then you can even save money in that house. Now, some parameters is where your house is located, because the depreciation can come also to the area where you are staying, where your house is located. That's why sometimes they say, don't overcapitalize in a house in the wrong area. Better to buy a small house in a very high value place. So that's the comment that I want to make. I don't know what Rick think about.
No, I agree with you. I do agree with you. Until you've paid off a house, it belongs to the bank. So that, yeah, I agree with you. I think there's definitely a lot of techniques in property investing. There's a lot of, and I've read that book as well, that Jason Lee. So I agree with you, 100%.
I don't know, I want to make a controversial statement, but what do you feel about the saying that older people are not aggressive? Do you think older people have a platform to be aggressive? Well, before we go into our next question.
Older people are not aggressive. Is that what you said?
Yes. How do you feel about that? And do you think that you have a platform to be aggressive?
Yeah, so this goes back to that time horizon spectrum that we looked at. When you are saving for retirement, if you've just started working, maybe you're going to work for 30, 40 years, and because of that, you can take on a little bit more risk. If you are retired, you're not going to have, you might, but we never know, but you're unlikely to have 40, 50 years to ride through ups and downs in a market, and I think the older you get, maybe already you've seen a lot, so you're more reluctant to take on that much more risk. So I would always say if someone has just retired, comes with money and says, help me invest, it would not be wise to put that money in something very, very risky. But on the other side to that, Divine, as well, is one of the investment questions we get is people living too long. And that's a problem because you may make provision for your retirement money to last you 10 years, but you live for 20 years. What happens to that extra 10 years that you didn't make provision for? So there's two sides to that. But yeah, I would say if you're older, you probably don't want to take on as much risk as someone much younger.
Okay, that's fair. We have another question that came in from Nanu, and it says, with everything happening globally, what will be the best investment? Like any ideas on what the best investment? And I mean, that's a tough question, but
Yeah. Yeah. So any question like that is very, very, it's very direct and it's very specific to the individual. If we look back to what we spoke about, your risk profile, your tolerance for risk, your experience, your age, your background, etc. Um, so I'm always very careful to like be 100% specific, like, you know, buy Bitcoin because I think it's going to do well. I would never say something like that. So I think we don't know where things are going economically. There's a lot of change happening. There's a lot of volatility in the world right now. Those are things we know for sure. And sometimes when there's a lot of volatility, there's a lot of noise. So you maybe sometimes it's better to stay put or stay out of the noise or try to find a way to gain some kind of to get an investment that isn't too volatile. But also, even when you say that, some people make most of their money when there's a lot of volatility, you know, so it's not like a one size fits all situation. But yeah, and that's why I say you'd have to go into a lot more. It's a lot more personal. What is your attitude towards money? Have you invested before? Is it your first investment? If you're to lose all your money now, are you likely to ever invest again? So a lot of, and that's where the whole field of behavioral finance comes in as well. So it's a very loaded question that you can't give like a 2-minute answer on a presentation like this.
No, that's a fair response. We have about 2 minutes left. I don't know if there's a last burning question that someone wants to ask.
Can I ask a question, please?
Please.
Thank you very much for the floor. I wanted to comment the presentation made by Eric. It is a very good presentation. He went into details, and you can see that he has is very well experienced in the field. But I have some concerns. If you have to see in terms of the objective we are trying to achieve, which is the education of the community on investment and saving and whatever. I think the presentation is very high. The level of the presentation is very high because the audience in his side is the expert, those who understand the field of investment. Then they can even understand the technical words used in the presentation. But I was expecting to focus on the education side because they are words people don't understand. For instance, when you're talking to someone about investment, the first question, the first answer will give you, I don't have money to invest. It means like to invest, you must have a lot of money. Right? But in the presentation, you can address those kind of concern that you can invest even the little you have. Because investment is not about thousands of rands or millions of rands, but even 20 rand you can invest. And in an organization like CoopCongo, we need even those people coming to invest 10 rand because those making a daily income, they can do that. Like I seen here in the DRC, those women selling stuff in the market, how do they survive? They have what they call cards. So every day they put their 100 Congolese franc and at the end of the month, it will be a lot of money, and that's how they sustain the way. So we have to educate people that don't wait for the day will have a lot of money to start investing. You can start from the little you have in order to invest. This is a comment I wanted to make at this point.
Yeah,
Thank
thank
you.
you for that. Thank you.
But I think
Can I
maybe,
respond to that, Divin?
please do.
Yeah,
Please do.
yeah. I think it's a very good point. You know, my view when presenting this was to use the words that they use and to try and simplify it for everybody else to use it. That was the thinking. But obviously, there's some gaps in that understanding from me. So I think maybe the solution is to have more and more and more of these sessions. So if I say asset allocation after 10 presentations, maybe people will actually understand what is asset allocation, what is diversification, what is a PE ratio. So I think yes, it's good to start at a basic level and work our way up. And maybe I didn't understand what that basic level looks like. So thank you for that. I think as we have more of these discussions and we discuss these topics, we discuss what people's views are, people's needs, we can start tailoring more and more of these presentations to our members. Ultimately, we want to we all pulling into the same direction. And we want everybody to be comfortable as we head to where we're going. So I agree and I take that on board.
But just to add on to that, I think it also maybe gives people here an opportunity to do homework and, to self-educate so that in the next time we talk about it, you would have done that homework and self-educated. And, when we try and also do our best to make it easier to understand for other people, but people are also curious to know that, oh, he said this term, let me go and find out about myself, because really that's what makes us who we are, right? It's the small people coming together to put the bigger picture. And I don't think we need to lose sight of that, and sight of that, like you said, we're all heading the same direction, and hopefully we can try better to take everyone along, but you also have to come to the party, so yeah. Okay, it's 4 minutes past 8 now, and I think probably it's a good time to stop, give people time to reflect. But on that note, if people actually do homework, and next week when we get into savings, like you can easily tie in savings and investments together, and it would be a good opportunity if people have done research and have other questions to ask. Next week is also a platform to do that. On my side, I really do want to say thank you for the great presentation that you gave us. I hope it was valuable to to someone, or more people than one actually. And it really is definitely a process that we are trying to get better at, and we'll get there slowly but surely. I don't know if you want to say any last words.
No, you took the words out of my mouth. I agree. We'll get there. So, I think yes, go ahead.
Yeah, it is on behalf of the CoopCongo board and management, and on behalf of the community, we really would like to thank both of you, Divin and Eric, for the brilliant presentation. And we are driving this so that our youth, what we want to call youth, will really drive with all your skills that you acquired in this country and which you are applying here and there. We really would like to extract as much as we can. So we thank you so much for the brilliant session. We would like to thank those that are joining from Congo with all the situations that there. the connectivity, Mr. Bruno Umba. We have Mr. Pierre Evariste Ngoy from Congo, who have joined us. I see Nanu Ngombe, which also joined us. So we thank all the guests that were part of this session, and back to you, Divine Mulan. Thanks.
Okay. No, I'm happy. And yeah, I want to just, thank you for giving us the platform to actually do this. It genuinely is our pleasure to educate and just to take you through some of the conversations that we have every week when we meet up. And this is definitely going to be something that we will keep pushing often, as much as we can, to get everyone on board with us. And yeah, I hope we all have a good night. And God bless.
Thank you. Thanks, everybody. Good night.
Thank you. Goodbye.
Good night.
Thank you.